losing money in your rental properties. Most investors don't realize they have made a bad deal until it's too late. When the rental property cash flow dries up, their property value drops like a rock, and they're stuck with a losing asset they can't unload. But it's not just the numbers on a spreadsheet. It is the sick feeling in your stomach when you realize the rent barely covers the bills. It is the stress of watching your emergency savings vanish into repairs you didn't budget for. And it's the sleepless nights wondering if this property, this investment, was the worst financial decision of your life. The difference between a profitable investment and a financial disaster happens before you even close a deal. One wrong assumption or one overlooked number, and boom, your dreams of passive income turn into a slow financial bleed. And the worst part, you won't even see it come. I am Jennifer Maldonado, and for over a decade, I have helped passive investors build real wealth. Not just by investing in my syndication deals where we manage $150 million in assets and we are growing, but by showing them how to analyze deals like a pro. My strategies have helped investors avoid costly mistakes, maximize cash flow, and create long-term financial freedom. And I have to tell you this, I learned this in the hard way. After doing multiple millions of dollars in transactions as an investor, we're always reminded that seasoned investors lose money too when they overlook key metrics or key market signals. And if I didn't have my numbers and market research correct, we could have lost six-figure incomes recently. And I mean it, a real, what I call tequila moment. And I barely drink. I just wanted to forget the stress that I was under. So if you ever felt unsure about buying a long-term rental property for passive income, in the next 25 minutes, I will break down the essential metrics and calculations you need to confidently separate the cash flow deals from the cash flops. And at the end, I will show you where to find the 10 critical micro market factors that most investors, yes, even the most experienced one, often overlook, helping you avoid common pitfalls. Being aware of those helped me save many of our own deals. You have found a property and now it's time to analyze it quickly and confidently. So let's determine if it's a cash flow deal or a cash flow. So I'm going to be using an example where the property is $200,000. And remember, it will apply the same kind of numbers. But your goals determine your metrics. What works for one investor might not work for another one, but this is the fundamental metrics. So let's zoom in into the two key drivers I teach all my passive investors to use when assessing a deal or even my own deals, right? So these two key drivers are income, how the cash flow flows through the deal, and the income is critical to sustain the investment. And equity is the other one. What you own after the debt, and it grows over time. It is your real ownership in an asset. In real estate, it is the portion of a property you truly own after subtracting the mortgage and any other debt. That's equity. Let's start with number one, income. And if you're focused on income, one of the quickest ways to screen a rental property is the 1% rule, a market-dependent metric that helps determine whether a property is likely to generate positive cash flow. It is important this is not a one-size-fits-all solution. In high-price markets like New York City or California, solid investments might not meet this rule, but that doesn't mean they're not good deals. It means that you need to do more analysis in the market. The 1% rule do this for you. It filters deals quickly before deep analysis, and it prevents overpaying for low-income properties. What it doesn't do, it doesn't account for equity growth or long-term wealth building potential. It doesn't account for or replace your due diligence. So here, how it really works, right? The rule states that monthly rent should be at least 1% of the total purchase price and renovations or other kind of cash, right? Let's take an example. We got this property for $200,000. We have renovation costs of $25,000. the total investment 225. The 1% rule calculation says take those $225,000 and multiply it by 0.1 and you will get 2,250. If a property costs 225, it should generate at least 2,250 to justify further analysis. It's not going to replace your due diligence again. It doesn't factor taxes, insurance, or vacancy. It's just a starting point to determine how likely you will generate positive cash flow potential with a regular rental business model. So, a couple of details. If you don't know how to find the rental, you can call local investors or go to network events and find out. You can call a property manager, expert in the area, and there's softwares like Rent-O-Meter, Redfin or Zillow or MLS that can help you compare local rental data. The real question here is you have to ask yourself if you need cash flow right now or are you looking for long-term equity. If the answer is only positive cash flow, then this 1% rule must be met, right? You're not considering other cash flow models like short-term, assisted living, and other types. Just letting you know, right? This is just based on regular rental. However, if you're considering hidden cash, you might reconsider the strategy that you're using because there might be equity on this property and it can generate cash. It's just not going to generate most likely the cash flow you want. Now, the next metric is net operating income. It represents the total revenue generated by a property after deducting operating expenses, but before financial costs, income taxes, depreciation, and capital expenditures. It's pure income potential. That's the net operating income. So how do you really calculate that? You're gonna take the gross rental income, the total rental collected from tenants. You're gonna take other type of income and additional revenue sources from parking fees, laundry, storage, maybe pets. And then you're gonna take operating expenses. The standard way to categorize an operating expense is to look for those directly related to the property core operations. Costs required to maintain and manage the property. If you take a loan, that is financial cost, not an operational cost. It doesn't include either the capital expenditures. A lot of real estate investors, very experienced, tend to add these metrics in here. So we have to use different metrics to work with those numbers. So here are real examples of core operation costs. Property management fees. Usually they go from 1 up to 11%. I'm gonna use for this example 10%, $200. Maintenance and repairs. This one depends on how old is your property and the size of your property. So this is not a perfect science, sorry, but you can get good guesstimations talking to other investors. So this is a single family home. I'm gonna put $100. Then you have property taxes. You can check at the assessor's office or the agency in your county that manage the property taxes. They will give you a rate of the valuation. I'm gonna put for this one $200. The insurance, you can always call an insurance broker. I'm gonna put $125. Then utilities, normally the tenant paid for that, so I'm gonna put $0. Then you have HOA, I'm gonna put $0 because I'm not paying HOA for these properties, and vacancy estimates. So this depends on your team. I'm gonna use 6%, $120, and other miscellaneous. These are fundamental expenses and they can change depending on area, cities, and it's important that you understand that this is, if it's your first time, it's okay that you're not familiar with the numbers, you will get familiar with. Let's take this example, right? $200,000 in the property, so $24,000 in annual income. I did that by taking 2,000 by 12 because of the 12 months in the year. Then I did 1,000, right? This is from pets, 1,200. And then we have the expenses, 8,940 in operating expenses or 745 per month. I'm gonna do the numbers. My net operating income is gonna be gross rent plus other income. So my $24,000 plus my $1,200 a year, that's gonna give me my $25,200. Then I have operating expenses, 8,940. So the NOI will be 25,200 less 8,940. That's 16 to 60 per year, or 1355 per month. And it tells me that the property generate this cash flow before your mortgage. Next question for you is if this number good enough for you. So we will use other metrics to give you a better insight. That other metric, we call it cash on cash. Cash on cash consider your actual cash investment. It tells you how hard your money worked for you. It tells you what you're really earning on your money after financing. So I'm going to use that strategically. This is how I measure the return on my actual cash. I have a little bit of a nuance on debt, but it's to protect my asset. I always use leverage investments. I account for financing and mortgages on my cash on cash, and I use it to compare different properties. It's just helped me assess if the deal provides the best return. And it determines if a property meets your financial goals too. It helps you decide if these investments align with your cash flow or is the cash flow. How do you really calculate cash on cash? You will need to calculate your mortgage payments, right? You can Google mortgage calculator and you will find plenty of free tools. So make sure you understand when using the calculator what it's included. Sometimes they include insurance and property taxes. You don't want to double count. The mortgage payment of $200,000 property, the estimate is $860 or $10,320 per year. I'm gonna assume a 20% down on the purchase price, right? The reason for that, that's the common practice out there. So we have to calculate the NOI, which was $16,260. And based on that, we will have to subtract to the mortgage payment. So if you ask me about that, the cash flow of this property after financial cost is 16,260 less 10,320, 5,940. And then you take that and you subtract and you're going to have 5,940. So now let's talk about the other portion of the expenses you need to calculate your cash on cash. Now let's talk about the total cash invested, right? That will be the down payment, closing costs, renovation, and other upfront expenses you will incur. Purchase price, $200,000. The down payment, 20%, it's $40,000. 20% of $200,000. The closing costs, they are between 1 to 2%. Let's assume $3,000. And the renovations, $25,000. So I add up all of those numbers. $40,000, $3,000, $25,000, my renovation, it's $68,000 total. So I take the 5,940, I divide it by 68%, multiply by 100, and that's going to give me around 8.73. What it's telling me is that it's going to take me 12.5 years to recover my investment. The question is if that's a good enough number. Cash on cash isn't the whole story. If you take, for example, the 8.73, you compare it to the market and what the bank offers, there might be some solutions, right? You want to see if this is worth it for you. Negatives about the cash on cash metric. It doesn't consider risk, doesn't factor economic downturns, vacancy risk on these markets, or market fluctuations. It doesn't consider exit strategy. It's great for cash flow, but how would you profit when you sell? If property values shift, your return of investment can change like this. It doesn't consider mortgage terms and interest rate variability. They're not considered. If you take a variable mortgage that can still shift over time and be more expensive, it will reduce your returns. And this is why a lot of investors overlook when they buy multifamily on the variable rates. Between volatility and rates, it's resulting in heavy losses. Also, it doesn't adjust for additional capital expenses or CapEx, right? Unexpected repairs or the profit killers. Positive, it doesn't account for long-term creation. It ignores appreciation and equity growth, and it focuses only on immediate returns, but it also can affect positively the amount of deductions that you have, right? It can impact your taxable income. So cash on cash is really great for measuring cash flow efficiency and to compare deals when it comes to cash flow efficiency. It will align with your short-term goals if that's what you're looking for. An 8% cash on cash return sounds good, But smart investors do not stop here. They continue to do research. And by the way, if you're serious about building wealth without the operational headaches, even these rental properties demand time and effort, then you need to read Why Savvy Investors Put Their Money in Syndications. I have written a report for you that breaks down the real pros and cons of syndication and includes a due diligence checklist so you can invest with clarity and confidence, so you can get the facts, the strategy, and the edge the sophisticated investors use to grow the wealth without the heavy lifting. Go in the link below and you can download your report. Here's your other metric, the gross rent multiplier, GRM, that helps you determine if a property is overpriced or a potential bargain by comparing its price to rental income. This is how you calculate this. The gross rental multiplier is the property price divided by the annual gross rent. It is calculated by dividing the property purchase price by the annual gross rental income. Yes, GRM does not account for expenses like property taxes, insurance, or maintenance, but I'm gonna tell you what we use this one. So let's take the same property of $200,000, right? It will be the $200,000 property price, and you're gonna divide it by the gross rental income, which it was $25,200, and that will give you 7.94%. So what does the GRM tells you? If it's a lower GRM, better, the property generates more income relative to its price. If it's a higher GRM, it's riskier because the property might be overpriced or low income producing. So you have to re-strategize that income producing. So rental, regular, long-term rental, regular income. In this case, it's reasonable for us to have that, but we need to dig deeper. And we do it with other calculation named as capitalization rate or cap rate. Pretty famous, right? It measures a property potential return. It excludes financial costs, but it helps investors compare similar properties in the same market. Cap rates are market dependent and they vary based on location and asset type, like multifamily, retail, office, and economic conditions too. So you want to make sure that you're comparing apples to apples, single family with single family, multifamily with multifamily. What all of this means, right? Let's talk about this. Let's use a cap rate. Let's suppose we have property A is a 10% cap rate, and I will show you how to calculate that in a second. Property B is 5% cap rate, and you have an FDIC insurance CD opportunity to invest of 4.75% return. So remember, property A and B must be in the same market and they have to be compared to each other. What the cap rate tells the investor is if you have a higher cap rate, 8 to 12%, you can expect higher risk but potential better returns. And a lower cap rate like the CD, 3 to 6, is lower risk but lower returns. And often you will see also this in premium market. If you're fully risk averse and don't want to learn anything about building up wealth and opportunities, most likely the CD account will be very sexy for you, up to $250,000. So the question really becomes, is the higher risk of real estate worth the potential return for you? And at first glance, some investors might say, of course it's no brainer because income producing property might be the goal. So they want to go ahead and jump at the 10% rate right away. Remember that cap rates do not factor in appreciation or the future property value growth, and it doesn't account for depreciation, the tax benefits. So for high income earners, they must consider higher tax bracket, and the real estate tax deductions and depreciation could significantly reduce their taxable income and federal tax liability. And this means that after tax return of the 5% cap rate property might contribute to reducing their tax bracket so they can keep more of the money they're making already. So I'm not going to get into the details of this one because we can talk about this for days. The question is, how do we calculate the cap rate, John? Let's take the $200,000 property again that generates $16,260 per year without financing. So you divide those and you multiply by 100 to get 12.3%. So this is a snapshot of the risk. So in the first part of this video, you learn how to assess a rental property like seasoned investors by using the key financial tools that help you spot risk before you sign that dotted line. So cap rate, compare risk return based on local market performance, the gross rental multiplier to quickly determine if you're overpaying or scoring a deal. Then you use your net operating income to evaluate a property true earning potential before financing, and the cash on cash to see what you are actually pocketing after financing and upfront costs. And let's not forget the 1% rule to quickly screen whether a deal is likely to generate passive cash flow in your market. We talk about another metric too, which was equity, or a key driver. Savvy investors combine these metrics that we discuss about income with the true ownership in an asset. It's one of the biggest indicators of wealth because it measures net ownership, not just income or cash flow. That is equity. So in order to understand equity and wealth, you need to take a look first of these financial statements. We name it, or we call it, balance sheets. Balance sheets, it includes equity, right? It also includes the income and the liabilities. Income is the money coming in, rent, fees, or whatever is that you make money with. The liabilities, what you owe, mortgages, expenses, taxes, and then you have that equity, your ownership stake in the property. Why do you even care about this? Your balance sheet reveals your financial health at any moment, showing if your investments are profitable, your debt is under control, and how much real wealth you're building. It is your wealth scorecard, is what we call it. And the more equity you build, the stronger your financial position in the eyes of a lender. So if you want to borrow money, lenders and other investors will check this before giving you a dime. So focusing only on income, yes, it will boost your cash flow. And if that's what you need right now, then you already know the metrics. But through wealth, building happens when you align your strategy, your cash flow strategy, with equity growth. So how does equity works in action? Let's measure this. Let's say you buy this property of $200,000 and you put down $40,000. And over time, you grow equity by paying down the loan, or by property appreciation, or let's call it by strategic improvements, which I love this kind of value added, right? Your goal is to keep increasing that equity because that's where the long-term wealth is built. So here's what you do. To determine if a property is truly worth your time and money, we will break down 4 powerful strategies used by most investors to build equity in real estate. So I'm coming with the assumption that even if your goal might be income, you're going to consider also building wealth. So let's start here. Number 1, buying the property below market value. This is my favorite strategy. And when I don't follow this strategy, I always get in trouble, and it takes a lot of work for me to make these deals profitable. So I start following Robert Kiyosaki principle. You make money when you buy. And this is why I prioritize acquiring properties at 10 to 30% discount from market value. So to evaluate the equity potential, you have to start determining the after repair value, the future value. And how you do that is you can call a realtor that is expert on the area and get some comps from other realtors, right? Or consult with an appraiser to understand how properties are valued in that area. But keep in mind, you will need to verify and confirm your data to ensure accuracy, like an appraisal will do. Please only use recently sold comps, not listed comp like many realtors do. Sorry guys, but they tend to do that, and that's not right. That's not what people pay, okay? So let's give you an example. You buy a $200,000 property at a 20% discount, instantly adding $40,000 in equity. So you pay $40,000 on down payment plus $40,000 on discount. That's $80,000 in total equity from day one. And you might be asking yourself why anybody will give me a discount. Motivated sellers often lease below market value because life events like divorce, probate, financial hardships, or simply needing to move quickly. And yes, with the right negotiation skills, you can uncover even better deals while still creating win-and-win outcomes. And this is one of my edges. My goal isn't just to chase a deeper discount. It's to understand the seller situation on a human level, because I love to add value to properties, but it's more important for me to add value to people's life. So I do this business not just to profit. I invest for profit. Yes, this is not a charity, but also I invest with purpose and I profit with impact. And this is how I have been unlocking deals most people never see. And this is where I really add a lot of value, doubling and tripling investors' money, okay? Something to think about. Here's your second strategy. It's what we call forced appreciation, adding value to the property. And it's one of the most effective ways to increase property value through this specific approach. You want to create upgrades, and some upgrades is adding a bedroom or an ADU, accessory dwelling unit or granny flat. And in fact, I have a video at the description below where I interview an ADU expert. Check her out if you want to learn that. Also, we add value by expanding square footage or by high impact renovations and upgrades. And sometimes I even take a single family home, take it down and build 3 to 4 units. So this is how you can add value. Then there's the third portion, the mortgage pay down. But I want you to do it with a smart approach. Yes, paying down your mortgages increase the ownership percentage, but here's the truth. I don't heavily factor this into my investment strategy. Instead, I focus on increasing income metrics and market-driven valuation and demand of products to determine profitability. Because if you're planning to pay off your mortgage, you want to explore other techniques like equity stripping to protect your investment, to protect your assets. And a lot of investors forget that. They get excited about paying down the mortgage and they forget about asset protection. So that's the reason why I don't like to pay off my mortgage. So real estate investing also is about leveraging your capital wisely. And locking up too much money in equity without maximizing cash flow limits your ability to scale faster. And at least you have like a lot of money coming from many places, and my private investors get to enjoy not only return, but more advanced education from tax strategy, equity stripping, and how to leverage the resources properly. And this is what I'm saying. It's a strategy out there, but watch out, you need to know how to do it. Then there's the other strategy, which is passive appreciation and rent increases, the unpredictable factors. And some investors rely on market appreciation and rent increases only. And relying on this strategy only can get you into cash flow problems. So when you can increase rents, that is the icing on the cake. But you should always buy right by paying the right price. Property values, affordability, and rental demand fluctuate with economic conditions. If the market shifts and you're relying on passive appreciation alone, it can lead to uncertain returns. So instead, I want you to combine appreciation with cash flow strategies to ensure both short-term and long-term gains, right? It's very important. Of course, here's my secret sauce. Number 5, I'm always evaluating the market. And my advanced market-driven strategy helped me see possibilities in the market that many people can't. So when I optimize property values, I increase equity and double or triple cash flow is because I focus on 10 factors out of the 13 factors that provide deep market understanding and insights. And for you, I have posted the video link at the bottom that shows the 10 factors on how to select your market. And having this information allows you to pivot quickly on your market from adapting the use of the property based on the area and use different models, to using other rental strategies to make the most out of your rental property. So it's important that you learn these factors to give you that little edge, that secret sauce that can help you. So I definitely invite you to watch that video. Let's summarize your investment game plan today, okay? You want to set your capital and determine how much money you have to access, right? Cash, financing, or other creative funding options. You want to find the deal. You want to source properties through your realtor, wholesaler, or investors network, or your own marketing. You want to collect financial data. You want to gather income and expenses details of the property. This is where you're going to use all of these metrics, where you're going to run the key metrics investment calculations. First one, the gross income, right? Total revenue from rent and other sources. You want to also see your cap rate, measure returns based on purchase price. You want to know your NOI, your net operating income, the revenue after operating expenses, and you want to know the cash on cash return, your return based on your actual cash investment. And of course, you don't want to forget about how to build your wealth. Analyze your equity. Remember, you make money when you buy. The selling price point is the eyes on the cake, but it is too uncertain to bet your savings on it. So always aim to secure equity up front for a stronger financial position. Remember, investing is about navigating risk and uncertainty with confidence. So always do your due diligence and learn your numbers. As promised, at the top here, you can click on the video to learn more about the 10 critical market factors that most investors, yes, even the experienced ones, often overlook. Go and watch it.